안녕하십니까. 이베스트투자증권의 글로벌 상품 영업팀 김성주입니다. 딱 작년 이맘때도 저희가 이제 CME그룹의 에릭 노란드님을 초청해가지고 2023년 이번 연도 경제 아웃룩을 한번 이제 전망해 봤는데요. 이번에 역시 이제 CME그룹의 에릭 노란드님을 다시 한번 초빙해가지고 2024년에 이제 경제 전망과 현재 마켓 상황이 어떻게 되는지 한번 알아보는 시간을 다시 한번 갖도록 하겠습니다. Thank you for coming in here again, and then please introduce yourself.
All right, well, thank you so much for having me back. My name is Erik Norland. I work as senior economist at CME Group, and I am based in London, England. And I try to follow all of the different markets that trade on the exchange, including financial products and commodities, and how they relate to the macroeconomy around the world.
네, 그러면 이제 뭐 한 초반에는 이제 에릭 노란드님께서 이제 한 20분에서 30분 정도 아웃룩을 한번 이제 전망을 한번 해보도록 하고, 그 후에는 이제 작년과 동일하게 이제 저희 강승희 대표님하고 조시열 전무님께서 궁금하신 점을 질문하는 형식으로 진행을 한번 해보도록 하겠습니다. Okay, please say something about the next year outlook and the recent market.
Right. Yeah. So, I think that the outlook is a very clouded outlook. In part because almost every central bank in the entire world has dramatically increased interest rates. The U.S. Federal Reserve, for example, has raised interest rates by 525 basis points. We have seen enormous interest rate increases here in Korea, in Australia, Canada, all throughout Latin America, as well as all of the European central banks have raised interest rates. In fact, there are only two central banks, the Bank of Japan and the People's Bank of China, that have not raised interest rates. And typically when a central bank raises interest rates, there is no immediate effect on the economy, or very little. But the effects are generally felt 1 to 2 years later. And so I think it's very likely that in 2024 and 2025, that the consequences of this extraordinary monetary tightening, the biggest global tightening of monetary policy since 1981, will really begin to be felt on the economy. One of the biggest changes that we've seen in the economy is the sudden rise of both short-term and long-term interest rates. For 40 years in the United States and in Europe, from the early 1980s up until the year 2021, interest rates were generally on a downward trend. So each high in interest rates was lower than the previous high, and each low in interest rates was lower than the previous low. That trend has now been broken. We now have short-term interest rates at the highest level since 2001, and we have long-term interest rates now at the highest level since 2007. And so all of this has dramatically increased borrowing costs after a decade from 2009 to 2021, 12 years in fact, a dozen years, in which everybody became accustomed to borrowing money for free. But the era of free money is now over. And so now investors have to think very differently about their investments. Any investment that they make has to pay more than the risk-free rate. So in the US, the risk-free rate is 5%, and here in Korea, it's closer to 4%. But any investment that they make, you have to assume it's going to return more than 4 or 5% per year. Otherwise, there's no point in taking the risk to make that investment. And as a result of this tremendous increase in bond yields, the prices of bonds have fallen very, very dramatically. If you look at the prices of 30-year bonds in the US, they have fallen by 56% from their highs. And so this has left the owners of those bonds with very, very large losses in their portfolios. And these include banks, insurance companies, pension funds, and other organizations that are sitting on perhaps $600 billion of losses in the United States alone, and much larger losses worldwide. Now, one of the consequences of the monetary policy tightening, both in the United States as well as in many other countries, has been that short-term interest rates are now higher than long-term interest rates. So we've now seen an inversion of the yield curve. And inversions of the yield curve happen every so often. And when they happen, it's often followed by an economic downturn. And those economic downturns are often followed 1 to 2 years after a yield curve inversion has begun. So for example, in the United States, we had a yield curve inversion in 1979, a recession in 1980. We had a yield curve inversion in late 1980 and early 1981, a huge recession in 1982. We had a yield curve inversion again in 1988 and 1989. We had a recession in 1990 and 1991. We had another yield curve inversion in 1999. We had a recession in 2001. We had another yield curve inversion in 2006 and early 2007. It was followed by the global financial crisis in 2008 and in 2009. So once again, we have a very, very sharp yield curve inversion. And this time you hear many people saying, well, look, the yield curve is inverted, but the economy is continuing to grow. In the US, for example, there was 4.9% annualized economic growth in the third quarter. This is something that is in fact very typical. Very typically you have the economy continuing to grow even when the yield curve is inverted. That was the case in 1999. It was the case in 1989. It was the case in 2006. It's usually 1 to 2 years later that you see the recession. So the fact that the economy continued to do well in the US in the third quarter, the fact that most countries around the world are not in recession is not surprising. What would be more surprising would be if the economic growth continued in the face of higher interest rates for another year or two. That seems very, very unlikely. When you look back at the past, you can see that we've had these 6 tightening cycles in the US over the last half century. Of those tightening cycles, 2 of them resulted in soft landings. Those are the ones that ended in 1984 and the one that ended in 1995. But I would point out that those tightening cycles are relatively small. In each case, the central bank raised rates by only about 300 basis points. This time they've gone over 500 basis points, so a much, much bigger tightening cycle. And then secondly, in those 2 cases, there was no inversion of the yield curve. But in cases in which the central bank raised interest rates a great deal and the yield curve inverted, there was a recession in every case, and those recessions began anywhere from 10 months to 17 months after the central bank's last rate hike. So you think about that in the context of the US. So the Fed's last rate hike that we think was in July. It's always possible it could go again in December, but it looks unlikely. But if you add 10 months to July 2023, that brings you to May 2024. If you add 17 months, that brings you to January 2025. So it looks very likely that at some point over the next, maybe year and a half, we could begin an economic recession, anywhere from as soon as perhaps the second quarter next year to as late maybe as the first quarter of 2025. So the risk of an economic downturn are really beginning to grow. And what's remarkable is this is not reflected at all in the bond market. In the bond market in the US, for example, the pricing is that the Fed keeps rates pretty much unchanged until May, and then they just slightly reduce rates to 4.25%, maybe by middle or late 2025. If we have even a soft landing, the Federal Reserve, I think, is likely to cut interest rates much more than that. And if we have a recession, they could bring interest rates, possibly to 2%, maybe to 1%, maybe even back to 0. So when I look at this forward curve, I think to myself, there's a lot of upside potential in short-term interest rates contracts, because those contracts gain in price if interest rates fall. On the other hand, if the economy continues to grow, there is some downside potential in those contracts if the Fed keeps interest rates where they are and does not cut as expected. But it looks to me like there is a skew of risk. So the price risk on short-term bonds may be much more positive than negative. So there's perhaps much more risk of extreme upside to short-term bond prices than extreme downside. And this brings into question a lot of commodities as well. One of the most mysterious commodities, I think, is gold. The price of gold has barely moved in the last 3 years and 3 months. The price of gold got to pretty high levels in July of 2000. The price of gold got up to $2,080 an ounce that month. And since then, in the last 3 years and 4 months, the price of gold has gone sideways. It's gone nowhere. It's been in this range from $1,600 to about $2,080 an ounce. So the question is why? Gold is supposed to be an inflation hedge. It's supposed to do well when you have inflation. And we've had tremendous inflation in many countries around the world, especially in Europe and the United States, but also in Korea, Canada, Australia. And gold prices have only gone sideways. So what happened? Well, I would argue that gold is actually a very good inflation hedge. But it's an inflation hedge that anticipates inflation before the inflation actually happens. And in this case, what's very interesting is at the end of 2018, the financial markets expected that the Fed was going to raise rates all the way up to 3%. But the Fed didn't do that. The Fed instead cut rates in 2019, and then at the beginning of the pandemic reduced rates to 0 and began printing $5 trillion of assets. And as that happened, the price of gold went from $1,200 to $2,080 an ounce. It rose just about 80% off of its lows. So you could argue that gold actually anticipated the inflation that we are now having, or that we had in recent years. The problem for gold is once that inflation struck, the central banks had to raise rates. And when central banks raise rates, it makes their paper currencies, the fiat currencies issued by central banks, seem relatively more attractive. So the dollar went from paying 0 interest to paying 5.3% interest. And that made gold not so attractive. But imagine if we wind up having an economic downturn as a result of all of these interest rate increases, and then the Fed has to cut interest rates a great deal. I think in that context, it is very likely that we will see a very, very large rally in gold that could take gold well beyond its previous high of $2,080 an ounce. And in fact, at the moment, at the time of this recording, gold is actually trading close to $2,000 an ounce, which is almost $400 higher than it was at this time 1 year ago. So gold, I think, is starting to anticipate that there's going to be a downturn. And when there's a downturn, the central banks are going to have to raise rates a great deal. Then you have the question of the equity markets. The equity markets are, in the United States anyway, are very, very highly valued. This, by the way, is not true in many other countries. If you look at the valuations here in Korea or in Japan or China or Western Europe, the valuation levels are not so high. But in the US, the S&P 500 and especially the NASDAQ index have extremely high valuation levels. Now that got the markets into trouble last year in 2022. In 2022, the S&P 500 fell about 25% from its peak to its low point in October. The NASDAQ fell closer to 30%. But then they turned around and they had this nice rally that lasted for about 9 months. From last October until kind of early summer 2023. But that rally was very strange. It was basically an 8-stock rally. There were a few big technology names like Tesla, Google, Amazon, Apple, Microsoft that did really, really well. Meta. Everything else basically went sideways or downwards. And since July, everything has begun to slide again, and especially in recent days, towards the end of October, we started seeing a really steep sell-off in the NASDAQ index and the S&P 500. So I think that they're becoming very concerned by the high level of long-term interest rates. If you can get 5% rates in a 10-year US Treasury, why would you take the additional risk of investing in stocks unless you believe that that stock is going to pay a lot more than 5% per year? But the problem, though, for these stocks is they're very highly valued, so they might not pay that much. And we know from past experience when there's economic downturns that the stock market can do very, very badly. For example, between 2000 and 2002, the S&P 500 fell 50%. The NASDAQ index fell 85%. In between October 2007 and March 2009, the S&P fell 60%. So it's possible that we could see another really big decline in the equity market. And if that is the case, that could put downward pressure on interest rates. It could force the central banks to begin cutting interest rates again. And that could be hugely beneficial for gold, and by extension, probably also pretty good for silver as well. And then on the commodity side, outside of gold and silver, you have the question of China. China is the major influence on most other commodity prices. It has a huge influence on the prices of agricultural goods like wheat, corn, and soybeans, especially soybean oil. Huge influence on industrial metals like aluminum and copper, and a tremendous influence on the price of oil. Now, what's really interesting about China is that when their growth rate gets to a very fast pace, like it did in 2007, like it did in 2010, 2017, or 2021, normally you see a major peak in commodity prices. It takes place about 1 year later. So after 2007, we saw a major peak in commodities in 2008. When China's economy was growing very fast in 2010, we saw a major peak in commodities in 2011. When China's economy was doing really well in 2017, commodity prices crested in 2018. Now, most recently, China had a very fast growth rate in 2021. Commodity prices peaked last year in 2022. Now, China's economy really struggled last year in 2022, mainly because of the COVID lockdowns. So they had very slow economic growth. Then last December, they abruptly lifted the COVID lockdowns. And so almost everybody, including me, expected the Chinese economy was going to have a great year in 2023. But it has not happened. So in some ways, the Chinese economy is doing better. People have started going out again. Nobody wears masks. Everybody's going out and having a good time. They're commuting back to the office. At the same time, however, Chinese consumer spending is extremely weak. Chinese exports and imports have begun falling quite significantly. So their trade sector is shrinking. And then most importantly, their real estate sector is shrinking very, very dramatically. And we've seen of China's 50 largest property developers, 34 of them have missed some sort of bond payment, including 3 of the very largest ones, Country Garden, Fantasia, and Evergrande. So the Chinese real estate sector is doing very, very badly. And so this year, China's growth rate is not spectacular. It's heading to be around 5%. So in some ways, China's economy is doing better. The COVID reopening is helping, but that is being counteracted by the downdraft of Chinese exports shrinking, weak consumer spending, and a very, very bad real estate market. And so none of this, to my mind, implies that commodities are about to do well. When I look at oil prices, it looks to me more likely than not that oil prices are going to decline. This, of course, is very difficult to know because of the situation between Israel and Hamas. It's creating a lot of geopolitical volatility that could make that, that sort of view of mine incorrect. So there's clearly a lot of upside risk for oil prices coming from geopolitics. But I think that there's a lot of downside risk for oil, and by extension for many, many other commodities that are highly correlated with oil, including corn, wheat, and soybeans. The metals are a little bit more of a mixed picture. Generally speaking, metals also follow what happens in China. Copper has been supported a little bit by the tremendous investments, especially in the United States, in infrastructure from the Inflation Reduction Act, which has provided $1 trillion of new infrastructure spending, much of that to do with the green energy transition, which uses a great deal of copper. But outside of copper, aluminum prices have done very badly. Lithium and cobalt prices are down. Steel prices have fallen very dramatically. So in general, industrial metals have not done very well. So that's kind of my overall view of the economy. The interest rate increases are likely to have a very negative effect on asset prices, including equities, as well as on the real economy in terms of GDP growth. So there's a lot of potential downside risk in equities. And China's economy is not doing much to support commodities at the moment. That could change, but if it does change, again, commodity prices tend to follow China with about a 1-year lag. So if you see China's growth rate improving, you might expect a rise in commodity prices, but that rise might not take place immediately.
현재 상황과 이제 내년 이제 금리 어떻게 조금 변동이 있을지 에릭 노란드님의 이제 의견을 들어봤고요. 이제 뭐 좀 가까이 앉아 계신 이제 강승희 대표님께서 먼저 한번 궁금하신 사항이 있으시면 한번 질문 좀 부탁드리겠습니다.
Thank you for your explanation and your view. And currently, is most of the investors is focused on the recession issue. The U.S. market get a recession or not? As you mentioned, as you explained before, just like still is a lot of the many issue in U.S. and then it's other country is totally different, especially is Japan and China is totally different. So that do you think is which factor is the recession factor? Which factor is the past recession factor? So I think normally is the most of cases positive news and the negative news. So some people expect the recession, some people not expect the recession. So do you have any factor category for the recession part and not recession part?
Right, yeah, so I think that there is a very high risk of an economic downturn in the US. It's not a 100% chance,
right.
but I would think the chance of a recession is probably greater than 60%. Maybe close to 80% chance that we have a recession at some point in 2024 or 2025. When I look around the world, I think it's more or less similar in most countries. Because we've gone from a zero interest rate environment to a very positive interest rate environment also in Europe and throughout much of the APAC region as well. In Korea, Australia, Singapore, a lot of countries have suddenly raised interest rates, and so this is a big shock to the economy for everybody who got used to borrowing at very, very inexpensive rates. But every recession is different. So I think that this recession is, if it happens, is going to look very different than the 2008 global financial crisis. That was a crisis mainly of residential real estate and of large banks. I think that this time maybe the most vulnerable places are commercial real estate, smaller to mid-sized banks. There's also a lot of variation. There are certain countries that also have big potential property bubbles like Australia, Canada, Sweden, Norway, maybe even Germany and France. I think there's a lot of potential to see economic crises around the world as a result of the higher interest rates.
But as you explained before, it's 1995, and then that case is not the recession, right?
Yes.
So in that time is that currently is M2 is reduced already.
Yeah.
And just like 95, but this case is if we focus on the positive side for the equity, and that is we can explain is currently is money is reduced, but is velocity of the M2 is a little bit going faster. I mean the speed is very faster. That means the economy can survive, just like compared to before. Even if you explain, it's a 70% possibility for the recession and 30% is the not recession. But in that time we'd like to check which case is not recession at the moment. I mean, for example, the commercial real estate price is going down already is finished, for example. And then commercial real estate is okay, and mortgage is okay, and then not that big financial crisis. And then most of the IT company even is a very high valuation, but AI and others, high tech, makes the productivity is going higher, more efficiently, and then it's very difficult to compare to before case. So it's even if 30%. So why is the 30% is happen? For example, I'd like to know is which factor. It's it's an economic factor. For example, inflation or the employment rate or just like this. Economist point is which factor is most important factor at the moment.
Yeah, so I think when it comes to the possibility of avoiding a recession, the arguments that I hear the most often are two arguments. So one argument is that consumers still have a lot of cash left over from the pandemic. So even if interest rates are higher, they don't really care so much because they still have a lot of money left to spend. So it's all okay. The other argument I hear is that when interest rates were extremely low, especially when long-term rates were extremely low, a lot of big corporations issued a lot of bonds and they borrowed a lot of cheap money and they can just live off that money for a long time. But there are of course other arguments. You have the productivity argument, etc. Now, there are also counter arguments. So the counter argument is that yes, consumers may have some money, but not everybody does. And suddenly credit card loans have gone from 15 to 21% interest. Mortgage rates are soaring. Now in some countries like the US, that doesn't matter because everybody's on a fixed rate mortgage for the entire life of the loan. So if the mortgage rate goes up, nobody's payment changes. But I live, for example, in the United Kingdom where everybody is on floating rate mortgages. And so I have friends in London whose mortgage rates, their mortgage payments have doubled or tripled or quadrupled. And this is very common in many countries. It's in Australia, it's in Spain, it's in many other countries around the world. Most people are on floating rates. So you have a lot of potential for economic stress. Secondly, when it comes to the idea that businesses locked in cheap financing, that's true for large corporations, but it's not at all true for small companies.
Like Apple.
I mean, small companies don't issue bonds in the bond market.
That's right.
They just don't. They don't have access to that, so they borrow money from banks. And the U.S. Federal Reserve publishes statistics on the average length of a bank loan. So the average length of a bank loan is 749 days, which is about 23 months, less than 2 years. So a lot of these small businesses are already seeing their cost of financing soaring, and they're having to make very difficult decisions about laying off staff, about future investments. And you also have lots of small startup companies that didn't borrow money at all. They, have essentially equity capital from friends and family, but it makes it really hard for them to grow into bigger companies now that bank loans are so expensive. And when it comes to productivity growth, we have seen some improvement in productivity growth, and certainly generative AI could fuel that growth maybe, but it's also a double-edged sword. Generative AI can improve productivity growth, but it is also a threat to many, many well-paid professions, including artists, including lawyers, accountants, writers, all sorts of people are now facing a threat. Actors and actresses, people who've always been protected from technological advancement are now facing the same threat that manufacturing workers have faced for decades.
So in your opinion, I just think about the situation, and then should be the US is okay, but it's other countries more problem. I mean, UK, where just like Korea, some of the country has a floating rates loan, and then that makes a real messy, right? So that means the US market is okay, but other places are more easy to crash.
Every country has plenty of problems. So I think in the U.S., if there is a crisis, it's going to be a crisis of commercial property and small, mid-sized banks, which in my mind makes the 1990-91 recession an interesting model for how this could potentially look. In the late 1980s and early 1990s, we had hundreds of small banks fail in the United States. So far this year, we've already seen 3 banks fail. We saw Signature, First Republic, and Silicon Valley Bank, or SVB. Now, these banks failed for a very specific reason. It's because they gained exposure to long-term bonds and did
yes.
not hedge it using
Yeah, that's
futures,
right.
which is
Yeah.
what they should have done.
Yeah.
And so they wound up losing capital. I think the subsequent failures, the real risk for the banks is not that. I think the real risk for the banks is going to be defaults, and especially defaults on commercial property loans for shopping centers, for shopping malls, for offices that have two problems. First, they have a lot of vacancy now. You know, the people in America anyway have not fully returned to the office, and they're shopping more online. And then secondly, you have much higher interest rates. So these properties are earning less money and their cost of financing has risen. And that's, I think, a really, really big problem for the owners, but also for the people who lent money to the owners of these properties.
Yeah, I agree. But it's a, I have no idea, but it's that, I mean, BlackRock with other asset management company is launched the lease products. It's a 10-year, I think it's around 20 years ago, just like the crisis in the 90s. At that time, the fund product is not that popular compared to now. So that means a bank is pretty healthier than before because most of the risk to the investor using the funds. And then I think it's very difficult to compare to before and now because it's a financial product is totally different. Previously is most of the loan from the bank, but currently is many people using the funds products. That means it's the insurance and the other pension funds is the invest the funds, not the bank. Right?
Yeah.
So
Yeah.
That means the risk is not that much contagion to other areas because they can disconnect to the crisis and the not crisis one.
Yes, but ultimately there is some owner for all of these products.
Yeah.
And so the owner can change, but it's kind of reminds me before the 2008 financial crisis, some people were saying, well, the big banks will be okay if real estate prices crash because they no longer keep the loans on their books.
Yeah.
They take the loans and they securitize the loans and then sell it on to others,
Yes.
including pension funds
Yeah,
and
yeah.
insurance companies,
Yeah.
et cetera. It turned out that the big banks were still in trouble anyway because of the subprime crisis, and many of them collapsed and had
Yeah.
to be bailed out. In this particular case, the insurance companies, I think, if they own a lot of commercial mortgage-backed securities, or if they have lent a lot of money to private equity firms, for example, all of these things could do potentially very badly. And one thing we're seeing around the world is that the cost of buying insurance is soaring. The homeowners insurance, insurance for shipping, all sorts of things that are insured. The cost of the insurance is rising very, very rapidly because the insurance companies' investments are not doing very well.
Yeah, that's also possible. So still, your opinion is 70% is a recession. That means its equity is not that great for coming 1 years.
Yeah. In the end, somebody's going to suffer and pay for all of this.
Yeah. Okay, thank you. And other one is the Japan issue. Yesterday is they changed their policy, YCC.
Yeah.
So mostly they take out the YCC.
Yeah.
And then everybody expect to the Japanese yen is going higher. I mean, the strength of the yen, but market is not moving that way, all the way. The weakness. So what is the big reason for that situation?
Well, Japan's in this really strange situation where Japan's been in different kinds of strange situations for a long, long time, really since the late 1980s. First they had their huge real estate bubble and equity bubble at the end of the 80s, which popped in the early 1990s and eventually pushed the economy into deflation. So Japan experienced deflation roughly from the end of the 1990s up until 2021. And then suddenly inflation started going back positive. And this is after they did this massive balance sheet expansion that began in 2012, under Shinzo Abe when he just came to power for the first time. He did this massive balance sheet expansion where the BOJ's balance sheet went from 40% to 120% of Japan's GDP. Now, you have to consider how big that is. The Fed's balance sheet right now, even after $5 trillion of QE, is 25% of US GDP. The European Central Bank is around 40% of Eurozone GDP. The Bank of Japan's at 120%. It's like
that's right.
3 times the size of the ECB and around 5 times the size of the Fed relative to the size of the Japanese economy. And so they were able to print all of this money and keep long-term interest rates low because inflation was way below their target. But now Japanese core inflation, so excluding food and energy, is now running at 4.2%, which is twice their target level. And this risks becoming very politically unpopular in Japan because Japan has an aging population. Elderly people on fixed incomes do not like inflation. And so the problem is the Bank of Japan is the only central bank other than the People's Bank of China that did not raise rates. Every other central bank on the entire planet raised rates, at least everyone I can think of. Maybe I'm missing somebody, I don't know. But every central bank whose name I know raised rates. And Japan still has their policy rate at negative 10 basis points. And so lifting the yield curve control doesn't address all of Japan's issues. So you have 4% inflation and negative 10 basis points real rate, nominal rates. Your real rates are negative 4%. In the US, real interest rates are now positive. In Canada, they're positive. In Korea, they're pretty close to being positive because inflation here in Korea is coming down. In Japan, it's not coming down. In Japan, it's very stable at 4%. And so I think there's a sense that, well, what if the currency weakens a great deal more and they continue to do nothing? And the other thing is Japan's public debt is over 200% of GDP. That's basically twice as much as almost any other major country. Like the next major country with a high level of debt would be Italy at around 130%. But Japan's up at 220%. That's just the public debt. When you add in the private debt, it's 400% of GDP. In Korea, the United States, Western Europe, those ratios are more like 250% of GDP. So the levels of debt are just staggering.
Totally.
And so it creates this problem. Well, if they start raising interest rates, how do you finance all of the debt? This is a problem everywhere, but it's a problem in Japan that's magnified because of the size of the debt. And so they're in this dilemma where the Bank of Japan maybe feels like it can't raise interest rates because of the size of the debt, but now inflation is persistent and they have their rates too low. So they need to raise interest rates, but they can't do it. And so the currency keeps falling.
That means the real Japanese economy is not that great, so it's going down for the Japanese yen.
In some ways a weak yen is good for Japan because it will cause them to buy less imports and will hopefully cause them to export more. But Japan's yen has been extremely weak. It's been really the weakest currency over the last decade or so. Especially over the last 3 or 4 years, it's been the world's weakest currency. And so Japan is in the process of going from being a very wealthy country to being more of a middle-income country.
Even if the euro yen is 160 at the moment, it is around 27th level. So it's pretty difficult to explain why they are doing that way. But it's most of people why is focused on Japan because it's the most of people focus on the U.S. Treasury long-term bonds yields. So it's Japan government, the BOJ is selling the U.S. Treasury or not. At the time, is no one buyer in the U.S. long-term Treasury. That makes more trouble in globally. Just like that kind of situation is happen. Do you think? Do you think that kind of situation is happen? I mean, BOJ is selling the long-term Treasury.
Oh, maybe. I mean, the thing is, the Bank of Japan just today suggested that they were going to potentially defend the yen. And so what that would imply is it would imply selling U.S. Treasuries in order to buy yen.
That's right.
Which is something they can do for a while. They have a lot of reserves, about $1 trillion or more of reserves. But this is something I think that is, along with higher JGB yields, is contributing to the updraft that we've seen worldwide in bond yields. 10, 30-year bond yields have been soaring in Europe, the US, many other markets following on what's happening in Japan. And that poses a risk to the equity markets around the world because equity investors now say, oh, if I can get 5% yields in bonds, why should I take the risk in stocks?
You mean it's the equity money transfer to the bond, so it's they think it's okay.
Maybe.
Yeah.
Yeah, I think investors are maybe waiting for bonds to hit bottom. And the thing is, at the moment, they keep going down. So maybe some investors are not willing to sell equities just yet because they don't want to, catch the falling knife, as they say.
Yeah. Possible, yes.
Yeah.
Thank you. And last one is the today night in Korean time, the FOMC meeting.
Yeah.
So many people expect the QT is the stop or not. Everyone is asked to the Powell about the QT monetary policy changing. So everyone is already has agreed no change the interest rate. So don't care about the interest changing, but it's a comment for the monetary policy, especially QT and reverse repo kind of. So do you think they will change some policy in the November and December or the next year?
So I think it's very unlikely they'll make any policy change this month. So I think obviously they won't move interest rates today. It's very unlikely.
Yeah.
I don't think they'll change the QT today either. The market gives maybe a 25% chance or so that they raise rates in December. I think if that were to happen, it would only happen if we have a lot of very strong economic data, strong inflation numbers. Otherwise, I don't think they're likely to do it. When it comes to QT, I think that what the Federal Reserve will do is the same thing they did in 2017 and 2018, which is to continue to shrink the balance sheet until something blows up. And so at the end of 2018, what blew up was the repo market for U.S. Treasuries.
Yeah.
It blew up around the holiday time and the end of December. And then the Federal Reserve started printing money again. So this time with their QT, they actually stopped it in March. They actually printed about a couple $100 billion in March with SVB and Signature and First Republic, and then they started doing the QT again. They'll keep doing it until something blows up. In terms of will they change monetary policy in 2024, I think it's very likely they'll cut interest rates in 2024. I think it's a question of when and how much. Last time we had a big tightening cycle. That tightening cycle ended in June 2006. In that case, they kept interest rates at a plateau for 15 months. And then at first they started cutting it slowly when we started having a recession, and then they panicked and cut very quickly.
And that is subprime crisis.
Yeah, during the subprime crisis. So this time around, I would suspect that if we have a soft landing, they'll cut very slowly. If it's a hard landing, they'll first cut slowly, and then they'll panic and cut a whole bunch. Yeah.
At times you can see some kind of big crisis or big events.
Yeah.
We don't know yet.
We don't know yet, but I think that with the biggest rate hike since 1981, I think that some sort of problems are very, very likely. I think it's just that we don't know for sure what they're going to be. But I would think that private equity, leveraged credit, commercial mortgage-backed securities, commercial property, regional banks, those are all a rich source of problems. They're not the only problems, but also small businesses could suffer. There's a lot of things that could potentially go wrong.
강승희 대표님께서 이제 매크로에 관한 질문을 해주셨고요. 이제 조시아 전무님께서 이제 커머디티, 상품 쪽에 관해서 질문을 좀 준비해 주셨는데 질문 좀 부탁드리겠습니다.
Thank you for the explanation. So I have some question. So the gold price become the bearish when the US dollar is strong and the interest rate is high. However, the gold price is quite bullish at the moment, despite of a high interest rate and the strong US dollar. So I think it's because of increasing geopolitical risk in the Middle East. So what do you think about the gold market? So do you think the price can go above kind of historical high this time? So I want to hear your kind of view.
I'm personally very bullish on gold. I think there's a strong possibility that it could break through its record highs from last year. Or really its triple top actually. It had a triple top. It's failed 3 times
Yeah,
now
yeah,
at
that's right.
$2,080 per ounce. And so you're right, the geopolitical tensions are rising. Now, what's really interesting to me about gold from a central bank perspective is that from 1981 or 1982 until 2007, the central banks were net sellers of gold every year. So central banks are taking the gold reserves and selling them into the market. And they were using that to buy other central banks' fiat currencies.
Yeah.
So even after the Asian financial crisis in 1997 and 1998, Korea, China, Japan, India, Thailand, etc., they increased the size of their currency reserves massively. And for the first 10 years, they mainly bought the bonds of very established central banks, like U.S. Treasury bonds, Eurozone debt, etc. Since 2010, or since 2008, the central banks have been net buyers of gold. They trust gold more than they trust the currencies issued by other central banks. And the geopolitical instability is only going to make that problem worse. So the U.S. has a tendency to use its currency as a weapon. So when Russia invaded Ukraine, the U.S. put Russia under sanctions. So now China's probably looking at this, and certainly the Russians are looking at this and saying, well, you know what, gold is a currency too, but it's a currency that the United States can't control. So in an environment in which we might, or in fact maybe already are in conflict with the United States, it is safer to invest in gold than it is in U.S. treasuries. Now I would add to that if we have a recession in the U.S., that the minimum, the central bank, the Federal Reserve, would cut interest rates very dramatically. And if they cut interest rates very dramatically, that makes the dollar less attractive for private sector investors relative to gold, and that would potentially be very bullish for gold as well. I think the most difficult component of this is the US dollar. So you rightly point out that gold is negatively correlated to the dollar index. The dollar's been a fairly strong currency. What happens to the dollar, to my mind, is kind of a mystery. The legendary bond investor Bill Gross used to say, comparing one fiat currency to another fiat currency is like trying to figure out which is the least dirty shirt. And so the thing is that they're all dirty shirts. US dollar is a dirty shirt, but so is the Korean won, so is the yen, so is the renminbi, so is the euro. All these currencies have problems. So trying to figure out which currency is going to go up and which one's going to go down is very difficult to say. But I think that there are several reasons at a minimum to be very bullish on gold.
You think the gold can be the clean shirt? Not the dirty
Gold is potentially by far the cleanest shirt. The thing is, gold is a boring shirt, right? It pays no interest. The other fiat currencies, you have to sort of like bribe people to hold them, right? So you do that by putting interest rates up. So when you put interest rates up, you encourage people to hold your currency. As you're paying them to hold it. Gold pays zero interest. So gold is a very plain shirt. It has, it's nice, pretty gold color, but it has nothing else going on. The other ones, though, if you reduce the interest rates, it makes it less interesting to hold them.
So maybe it's a can be the good reason to kind of think about kind of gold again, even in the very high kind of level of the gold price. Okay, so the question about the oil market, so actually the stock level of oil and oil product is quite low these days, and then production cut of the OPEC countries expanded. So I think the supply side is a bit tight these days, but the oil price quite stable these days. So even with the kind of a situation of a conflict in the Middle East, so I think the oil price is quite stable these days. Is there any reason? So what do you think about kind of oil current kind of market situation?
Right, so I think oil, as you point out, it's in a very interesting situation. The price is about the same as it was one year ago. Even though OPEC cut 3.6 million barrels per day of production. That's a really big production cut. you would have imagined with them taking 3.6% of global production off the market, the prices might have gone much higher.
Yeah.
But the problem for OPEC is two things have happened. So first, U.S. production has increased by 1.2 million barrels per day. It just hit a record last week of 13.2 million barrels
Historical
per
high,
day,
yeah.
historical high. So the U.S. by itself has replaced 1/3 of what OPEC cut. In addition to that, other smaller countries like Ghana and Cameroon and other smaller actors in the market have also increased their production a little bit as well. So together they replaced roughly half of what OPEC cut. Then the other half is China. China's economy has not recovered as quickly as expected. And so global oil demand is a bit weak. We also have the energy transition happening. In China now, 38% of all the vehicles sold are electric vehicles. In the US, we went from selling around 50,000 electric vehicles per quarter, so every 3 months, to selling 300,000 from 2020 to now. So we've had a 600% growth in EVs in the US in terms of sales. And so basically, just to keep demand stable, people have to drive 2% more each year, just in order to keep the demand stable. But the problem is in China, people are driving only as much now as they did in 2019, but they're probably consuming maybe 6 or 8% less fuel because their vehicles are more efficient. And the same thing in the US. In the US, people are driving the same now as they were before the pandemic, but on average, their cars are consuming perhaps 6 to 8% less fuel per unit of distance driven. So this is a huge headwind for OPEC. But you're right also about one other thing, which is the inventories are low.
Yeah.
So there is always the risk of extreme upside, especially if the conflict between Israel and Hamas somehow broadens into a bigger war in the Middle East, which doesn't seem likely at the moment, but it's not impossible.
Yeah. So I was surprised because oil price is quite stable. So even with the kind of
No.
the conflict in the Middle East, so I just want to ask about the question.
Yeah, I mean, I guess the good news for oil is neither Israel nor the Palestinians produce any significant quantity of oil. So long as it remains limited to there, it doesn't have a big impact on petrol prices.
Okay, and the China is known as a kind of a world kind of factory. So actually Chinese economy have a big impact on kind of commodity market. So as you know that the Chinese economy is in trouble because of a kind of high level of debt and kind of a real estate kind of problem. So but result of that, so the commodity kind of market is a bit bearish these days. So so do you think that the kind of weak commodity market will go further for long term? So because there is some lag between the kind of a Chinese economy and the commodity market. So actually, even if the Chinese economy recovered, actually there should be some gap between the economy and the commodity price. So I just want to have your view on the in general kind of commodity market.
Yeah, I think that I think that China's economy, you're right, is still very, very soft. And it has not shown a lot of improvement in its growth rate this year. Now in China, essentially two things are happening simultaneously. On the one hand, you do have some positive year-on-year growth because of the COVID reopening. But that's being offset though by the decline in imports and exports, the decline in real estate and construction activity, and relatively weak consumer spending. And so none of this is very positive for commodity prices. So I don't really see anything coming from China that's going to cause commodity prices to go way up. Now, some of the manufacturing activity in China is leaving to other countries. It's not like it's disappearing. It's going to Vietnam, it's going to Mexico, maybe a little bit to India or Indonesia or the Philippines. And so that might help to stoke a bit of demand. But I think the biggest risk for commodities outside of China is the fact of all these interest rate increases around the world. that's increasing everybody's cost of capital, which is going to potentially slow both consumer spending and business investment worldwide. And that will be potentially very negative for China, for commodity prices, for trade activity around the world.
Thank you very much for explanation.
Thank you.
조세호 전무님의 이제 뭐 커뮤니티 상품의 이제 골드부터 시작해서 이제 전체적인 커뮤니티 시장 전망에 대해서 질문을 하는 답변을 이제 다 끝냈고요. 그러면 이제 오늘 시간을 여기서 이제 마치도록 하고, actually how was you thinking about the second time of the YouTube filming?
Yeah, so it's been a great pleasure to be back. So thank you so much for having me. And it's been a huge pleasure to be back here in Korea. So 감사합니다.
내년도 이제 전망에 대해서 한번 알아봤고요. 이거 시청해주시는 모든 분들께서도 조금이나마 도움이 될 수 있는 이제 영상이 되었으면 좋겠습니다. 그러면 내년에도 이런 좋은 기회가 있으면 에릭 놀란드님이 다시 한번 모셔서 방송 한번 촬영하도록 하겠습니다. 시청해주셔서 감사합니다.